Okay, this is video number 2, and I should be able to get us through the rest of the assignment on this one. Sorry I had to cut the last one off there a little short. I only want the videos to be about 20 minutes because it takes a long time to upload them, and I don't want it to crash because that's happened to me before and I had to start over. So I apologize for just kind of cutting it off at the end there. We're going to start with the asset efficiency section now because we finished the liquidity section and we got our graph looking good. In this section, we're going to focus our attention on how many days does it take us to collect those receivables. So we're kind of digging into the next level of what's causing some of these issues, where should we focus our attention, what kind of recommendations would we maybe make to help improve the company and make it look stronger. So we're going to look at how many days does it take us to collect receivables. And we'd want that number of days to be very close to whatever terms we've given our customers. So it just depends on the company. Most standard terms for smaller businesses would be about 30 days. Lockheed Martin is a really large business and they have contracts with the government. My guess is that their standard terms are a little bit longer than that. And we could probably dig that out in the annual report. And if we were doing a real sophisticated analysis, I'd say, yeah, let's go do that. Let's go dig it out. See if we can find it, or do a search on the internet, see if we can dig it out. But I think I can probably guess anyways, because I've done this enough times that I know what I'm looking for. So I'll give you some insight on that when we calculate it. The second one is having us look at inventory more closely, and it's telling us how many days the inventory is on hand before it gets sold. So if I add the two of those numbers together, I get what's called operating cycle, which is really important because it tells me the length of time that it takes from when I buy my inventory and I hold it, it sits on a shelf, so to speak. You know, Lockheed Martin, they really build to order. But inventory's on hand for a period of time before it gets into the customer's hand, before it's sold to them, before the exchange occurs and we can book the revenue. And then it becomes a receivable, and it takes a little bit longer to collect the money from the customer. So we've got both the days that the inventory is tied up, we got cash flows tied up in inventory, and we got cash flows tied up in receivables. So it just adds the two together. But as you saw in Chapter 6 in Solid Footing, oftentimes when we buy our inventory, we put it on account. So for me to say, well, this is how long I have my inventory and how long I have my receivables, it's not really fair because maybe I haven't paid for them yet. So I really don't have cash tied up that long. So I want to subtract from it the number of days that I have in accounts payable. And then I get the cash conversion cycle. So that's what we're going to do in this next section. Let's give it a shot. So here we have the days sales receivable, days sales outstanding. I'm going to have you type in 365. And then I'm going to have you divide that by the receivables turnover. So what we want to do is put in the parentheses first. We're going to go get sales. Then we're going to divide by average receivables. So sales is on the income statement. Make sure you grab the grand total. And then hit divide, type the word average. Just type it right out. You'll see the function pop up. Open parentheses. Go to the balance sheet and grab average receivables. And then hit close parentheses. That closes the average. And then hit close one more time. That closes the denominator. So the parentheses are super important for giving the order of operations. Now I can copy that across. And notice what I see here. So in the first 3 years, I see it took about 60 days, 61 to 63 days, which would lead me to believe that their terms are probably around 60 days. But then I see this strange falling off in 18 and 19. If I go back and I look at my receivables, I can see what happened. So look in these 4 years back here, there were no contract assets. And remember what I said earlier, that this change they had was a result of a change in GAAP in the way revenue is recognized, and it was done in an attempt to get it closer to what's going on in IFRS so that the two are less different. But that means I've got to make an adjustment to my formula to pull in these two pieces so that I get a better representation of what's going on. Because these really are receivables. They're just being classified a little differently. So I'm going to yank that into my formula by calculating the average of these as well and pulling them in. So let me go back and edit my formula. I'll edit this one right here. Oh, right there, just outside of that one. I want to add to it the average of those other ones. So I want to include these in the denominator here. And I probably, now that I've got two things there in the denominator going on, I probably should, oops, right here, get that done first, because I want this to combine at the denominator level before it does this division into this numerator, which is then divided into the 365. That should work. Yep, that's going to be fine. I need to copy that one to this one because this one was different too. And those are more in line with this now, and now I got apples to apples. However, I don't like the fact that it's increased so much. Right, so again, when you get these ratios, they don't necessarily tell you exactly what's wrong. They just point out different strengths and weaknesses and areas that maybe you want to double check as a company to make sure things aren't going awry. And this is one of those areas. You don't want to let your day sales receivables get too large or grow too quickly, because that means you got more money tied up in receivables and you're not able to collect the balances that are due to you. And that will impact your liquidity, right? So this is helping us gain some insight on where the potential problems are. And we kind of knew we had problems both with receivables and perhaps with inventory. It would help us a lot if we could collect this a lot faster than that. All right, now let's do the same thing with inventory. This one we got to be careful because we're going to go grab cost of goods sold and it has a minus sign around it. So we just got to be careful how we do that. So equals 365 divided by, go get your cost of goods sold, cost of sales right there, and then divide average. And we go back to the balance sheet, averaging the inventory, just the first two, because that's beginning and ending of the year balance. All right. I also have to put parentheses around this. Yep, and I got to get rid of this negative sign. So, to do that, I need to put a minus in front of the cost of goods sold. Let me just double check that. Oops. Let's try it here. That's what I wanted. Okay, that'll work right there. Let me explain. Back here on the income statement, I have this in as a cost, which it is, and it's an expense on the income statement. But I don't want it to go in the ratio as a minus. So I have to kind of trick Excel, and oftentimes we have to do this, especially with ratios. When we put minuses in, we just want to know what the ratio is. So I want to know the number of days. And it's not negative days, it's just days. So you got to get rid of the negatives. And you can trick Excel by putting a minus out in front of a cell that's minus, and that makes it positive. So I usually do it first to show the minus, and then I make sure I get the minus in the right place to just flip the sign. That one's good to go. All right, and this is somewhat encouraging that they've done some work to get their inventory, days in inventory down. So they were as high as 42 almost, and 40 back here, and they've been pulling that down. This year, this looks much better. So I'm encouraged by that. And you see that improvement in this ratio, which doesn't have the inventory in it, and you see a big improvement there over the previous year. So they have strength in this middle level, and I would attribute that to this improvement in their inventory management. I don't think they're going to do a lot better than that. That's pretty good for them. All right, now this is just the sum of these two. So I'm going to add them together and pull it across. Technically, I think it looks better if you just convert these so they don't have any zeros because they're days. So let them round to whatever the nearest day is. So it takes 71 days to collect our receivables. In the most recent year, it takes 23 days before that inventory is in the customer's hands, which is pretty good for them. That means it takes about 95 days for them to get cash in our pocket, in Lockheed Martin's pocket, from the number of days it takes in the inventory and the number of days it takes to collect. However, some of that's not paid for yet, so you got to make this additional calculation and open your parentheses, go get your cost of goods sold again. We're going to have to do that same trick. divide average, go get your payables, just the accounts payable, close that up. I need another parentheses on the back side, so that's what that message was. Is I forgot to put that other one on. And then remember to put this minus out in front, right, to trick that. That's perfect. All right, here we go. And you can get rid of those zeros. So it takes, we're a quick payer. We're a good payer, right? If they're giving us 30 days to pay, I would suggest they slow down their payments so that they can recover some of their working capital loss and strengthen this. Because if they don't have to pay that so fast, then they can hold on to their cash faster, more. Right, so if you slow down your bills, but still pay them on time, that means you have more cash in your pocket for longer periods of time than giving it to whoever your vendors are. All right, so then you take this operating cycle and you subtract the days sales payable. That's telling us how many days we've got money tied up right there. And it's been, that's our best one out of the 5 that we're studying. All right. So again, where would we seek to improve? Probably in the receivables. And then if you slowed this down, you could shrink this even more. And I would say they probably have terms of 30, so why are you paying so early? Unless they get a huge discount and there's some incentive for them to do that. Like, so again, it just leads us to asking better questions and targeted questions so that we can examine the business and be effective in our decision making. All right, now profitability ratios are extremely important, but don't let me get ahead of myself. Before I do that, I want to graph these ratios that we did here. And what I'm going to do is highlight these first 2, because those are the receivables and the inventory. And then I'm going to pull in the DSP. Let's see how this looks. I'm not sure I want to get all of these on there. Let's start by going to Insert and do another line graph. Yep. Okay, right click on the graph, select Data, and Series 1, I want to go to Edit, and I'm just going to type DSO as opposed to going over here because I don't want all that stuff. And then this one, I'm going to edit that one. This one's DSI. And then I'm going to edit these, and I'm going to pick the dates again. Very good. Let's take a look at that. Let's add some data labels. Yep. Nice. All right. So this is a nice trend. Right? Impressive that they've been able to manage that. This trend we're not happy about because we see the number of days it takes us to collect our accounts receivables going up. All right. Then I would like to add this DSP. So if you right click, select Data, Add DSP. And then get its values. They're right here. Hit Enter. That should be fine. I'm not sure we needed to do that, but just to be safe. Okay, looks good. All right. Data labels. Very nice. All right, so I think that's fine, having the 3 of those on there. That way we're not crowding it with the subtotals, the operating cycle and the cash conversion. If you wanted to, you could put the operating cycle and the cash conversion on a separate one. Let's do that. I think that would look really cool. So DSO, DSI, and DSP. Let's give it a nice title. And then just highlight one of those. That's fine. Go to Insert. I just find it faster to do that. Okay. Oops. There we go. And we can right click on that, select the data, edit that series. We can grab that. Type that one over. Operating cycle, say OK, and then edit this, grab that, say OK. Let's take a peek. We can add our data labels. Okay, so we've really made some huge improvements. I'm so impressed with that, and it's mostly because of the inventory. Now if we want to add the cash conversion, you right click on that, select data, add, and let's go ahead and grab that cash conversion cycle, and then grab those values that are underneath there. Yeah, that's fine. And say OK. And say edit, get those dates. That's fine. OK. Add your data labels, right click on it, add data labels. Alright, so you see a similar pattern here. And let's get a title on that. For some reason it didn't give my legends and stuff. And I want it to look like the other ones. That's perfect. Okay. Add our data labels again. For some reason we lost them. And this is operating and cash conversion cycle. Alright, so you see the improvements in that as well. When you look at that, you see it coming down. So obviously a lot of that has to do with the inventory. They could improve this even more if they were to get better with their receivables and lengthen out the DSP, Day Sales Payables. I would pop that up so that it would drop this down, which is what we want. We don't want our money tied up in these assets. So that helps us gain some insights on that. Let's do our profitability ratios. These are all income statement items. So in every case, what we're going to do here is take the gross profit and divide by sales. So for that one, that's what we do. The operating profit, divide by sales. Operating profit's here. Divide by sales. And then the net income, net profit margin, divided by sales. So they're all divided by sales, and they just tell you what's the percentage profitability of our items and how's that been playing out for us. So gross profit is the profit after we subtract cost of goods sold from sales. Operating profit is profit after we subtract and add operating related expenses and other income. And then net profit margin is the bottom line. So that's the bottom profit number over the top number, sales, to see what percent. That means that after it's all said and done, I keep 10 cents on every dollar that I make in revenue. Okay, and you might think that's pretty low, but it's actually pretty standard, especially for a company of this size. And it's still a ton of money. There are companies that do a lot better than this. Apple has historically been in the 20%. McDonald's is another really strong performer. So there are companies that really nail the bottom line. But Lockheed Martin obviously isn't one of them. They were near break-even point in 2017. Remember, that was the year they had that big tax hit. But most of the time they were hovering around an average of 10%. So I highlighted all of those. I'm going to insert a line graph there. That works. And just slide that over a little bit so it's not right on top of our numbers. And let's clean this up. So if we right mouse click, select the data, and we edit Series 1. Series 1 is gross profit margin. And okay, edit Series 2. And it's operating profit margin. And edit Series 3. Net profit margin. Bottom line. So it's top line profit number, middle line profit number, bottom of the income statement profit number. Let's get our dates. Oops, went too far. Okay, that looks good. Alright, let's add some data labels. Right click, add a label. Right click, add label. Right click, add label. Alright, so this is kind of compressed on each other here. Bottom one is showing that huge dip there. That's that year they had a tax problem. If we hadn't had that tax issue impact the business, then things would have been a lot smoother in terms of the way this graph looks. I do like that this is increasing, even though it's just slight. They definitely are making progress. Companies like this, even a tiny little bit of progress on their percentage returns means big money because they're such big companies. Okay, so this is your profitability ratios. Okay, let me move this one. There we go. We got one more section to do. Solvency, I'm going to fix this. This kind of bothers me. So, solvency is our last section. It has to do with our debt, our leverage, we call that. So, another name for having debt is leveraging your business or using debt in your financing. So what we do is we take a look at the proportion of liabilities. So this is total liabilities divided by total assets. And we look at the equation and see, well, what portion of the assets are financed with debt. So let's go to the balance sheet and take total liabilities right there and divide by total assets right there. And you already looked at this initially. And one of the things we would say, like, look at that. There was a year there, and that was the year they had that big tax problem, that they had more debt than they had assets. So they had negative equity. And I want you to realize that that sounds really bad, but if you look at their market value of equity, which if you remember was the 90-some billion dollars of equity, then it's not as bad as you think. Right? You have to recognize that these book values are not necessarily market values. And that's a fairly new phenomenon. I never used to see this. Companies running their debt up so high. I think it's a function of the interest rates have been knocked way down and they have never recovered, and I don't think they ever will. And so companies just use a lot of debt as much as they can without tipping the balance sheet over, right? And they're running it pretty much assets and liabilities. And then they have their equity value, their market value. How can you blame them, really? So anyways, this one we're going to do the long-term debt, and I might have to do a calculation, so I probably will, because I don't think I have a total. Let's just check. Yeah, see, I don't have a total for long-term, so I'm going to have to add these together. That's easy to do. So just take equals sum, open parentheses, go to the balance sheet, grab all the long-term, which are right there. Those are the long-term liabilities, and then divide that by total assets. So make sure you close your parentheses, hit divide, and click total assets and click enter, and you can copy that across. Alright, so of this total, 64% of that is long-term debt, and the rest is the current liabilities. Now this one is just another way of looking at the debt equity relationship. It's not a ratio I typically prefer. I actually really like the debt ratio and the long-term debt ratio. I find them more relevant to me because I'm always thinking about, well, what is it relative to assets? But this gives you another way of looking at it, and I'll teach it to you because you'll probably see it again. So you take total liabilities, it's debt to equity, total liabilities to total equity. So that's easy. Total liabilities divided by total equity. Right? We're going to have a problem right there. I'm not going to flip that sign because it is truly negative. Alright, that's crazy, huh? Yeah. And it's because there's just so much debt to equity. It's almost infinitesimal, right? Alright, this one is a ratio that we use that looks at the balance sheet to see if we got enough profits to cover the interest expense. So we use what's called EBIT, which is earnings before interest and taxes, which is also what we call operating profit. So it's just a finance term that we use. If you go to the income statement, earnings before interest and tax is really this one. So let's just use that. And then we're going to divide by the interest. We got another problem. That's negative. We don't want it to be negative. So when I hit enter, I'll take it back. It's negative. And I don't want that as a percentage, so please fix that. I want that as a number. And now to get rid of that negative sign, go to the denominator right before that little indicator. Hit minus, and there you go. It just turns the sign over. That's exactly what we want right there. So this is telling us that I have $13 in profits for every $1 I owe in interest. That's extremely strong. I like to see a ratio of at least 4 or more here. So it's very strong. Something else I often do is look at sales growth, asset growth, net income growth. I had you do that in the first assignment. I'm going to show you how to do it here so we can look at it over time. So I'm just going to grab sales here and minus sales here, and then divide by sales here, and that tells me, oops, sorry, I made a mistake there. Let's start over. Equals, open parentheses, sales minus sales, put parentheses on it, hit divide, sales. Okay, so it tells us that's how much they grew from 18 to 19. And I can only go 4 years because I'm using this base year here to get this one. Alright, so that's a little bit of a problem here, and they crawled out of it and they're on their way back, but certainly this was the strongest year of sales growth. Still, double-digit sales growth is wonderful. All right, so now I usually look at how our assets growing relative to sales to make sure that this growth isn't being destroyed by overinvestments in assets. So look at assets minus assets, close the parentheses, divide by assets. So it's base minus the year ahead divided by base. All right, so great. That means sales are outpacing the growth in assets, and that's exactly what I want to see. Okay, assets actually shrunk here and shrunk here and shrunk here, which is awesome. That means they're being efficient, they're managing the resources, they're not over-investing. That's good. So here's another one. Let's look at net income growth. So this minus this, close it up, divide by this. Yeah. So they got some fixed costs in there. So the sales growth, you're seeing much better, right? Here's where we had that loss because we had that see, big dip down because of the tax problem they had. So you're seeing kind of strange numbers evolve because of that. This is an incredible amount of growth and profits in a year's time. All right, and then earnings before tax growth would help me get rid of this bumpy, lumpy stuff so I can make more sense of this and get rid of that tax issue that we had. So I'm just going to look at this number before the taxes, this one right here. So that's sometimes what you have to do to get rid of some kind of anomaly. Yeah. Yeah, see, that makes a lot more sense. Right? That's a truer pattern of their profitability growth than this one is, because there was the tax issue, which isn't anything they have any control over. It's just based on tax laws. So sometimes you have to look up a level at profitability to kind of flush out an anomaly like that. All right, so hopefully you've learned a lot from this. I'm going to do another graph on the solvency, so you've got that for your assignment, and then we're pretty much done. Hopefully I haven't gone too far over my plan limit. So let's do this. Let's do both of these, because if we add this one on a chart, it's just going to look ridiculous, and it's going to dwarf these. But these together are meaningful, because this is all the debt to assets. This one's just the long-term debt, which is the risky debt, because it goes on forever, and it bears interest. So we want to look at both of these. Highlight both, go to Insert, and then Line Graph. Okay, and we'll pull this down and clean it up. Well, maybe I'll just set it here because it's being a bugger. I can move it down now. So this one is solvency ratios. Now let's get in there and label them. Right mouse click, select the data. Series 1, edit, is the debt ratio. That one. And Series 2 is the long-term debt ratio. Okay, let's edit the years. Okay. Let's add some data labels. Alright, I like the trend that it is coming down, right? It's still really, really high, but I do like the fact that it's starting to come down at least somewhat. And again, it's all relative to the market value of the company, so it might not be all that important. Now this one, we could do a separate graph for that. We could actually do a bar graph. Just take a look at that one item, just to have something a little different. Yeah, let's do one of these. Oops, sorry, I did not mean to grab that. That's not what I wanted. Insert. There we go. That's the one I want. That's fine. Okay. Just to have something different. This is what's called times interest earned. And bigger is better here. Okay, so you can label these, add data labels, so you can see what's going on. And if you want to change that 1, 2, 3, 4, 5, go to select data and go to edit and select that, highlight years. Got that. And if you want to edit this, the name is time to interest earned. Okay, good. Okay, let's take a look. Okay, cool. If you want a trend line on that, then that's kind of cool to see. This helps connect the pieces. So this is an improvement from 15 to 19. They've increased the amount of profitability they have for every dollar of interest. And that reflects and sends the same message that you're seeing here, that it's coming down a little bit. So I would say solvency has improved some, just not by like huge amounts. They still have an incredible amount of debt to assets. All right, I'm happy if you could get that much done for me. Paste these in, say a little something about each graph. If you have some additional ways in which you want to graph the data that you think would be interesting, you want to give it a try, by all means, go for that. But at a minimum, at least do what I've got here and post those in. So you're going to take each one of these graphs and copy them and paste them into the discussion board and say something about what you got there. Okay? All right, I hope that helps. If you have any questions, be sure to let me know.